All right, welcome to The Explainer. Today, we are tackling a massive, literally market-defining thesis, the great AI maturation. We're taking data from recent hyperscaler earnings, global supply chain analyses, and institutional Wall Street capital flows to look at a really bold premise. We are talking about the idea that the AI supercycle is officially transitioning out of its infrastructure phase and moving aggressively right into the application phase. It's a monumental rotation of capital from the hardware giants building the data centers straight into the software companies that are actually going to monetize all that new computational power. This is a fundamental shift in the whole AI narrative, and we're going to break down exactly how and why it's happening right now. But hey, real quick before we get into the heavy analysis, I just want to warmly welcome all of our returning viewers back to the Noob Selling Options channel. You know, if you love deep dives into market mechanics and data-driven analysis just as much as we do, please make sure to hit that like button and subscribe. It really goes a long way in helping us keep bringing you these high-level explainers. Okay, let's dive into this. The entire core premise we're dismantling today hinges on one very specific question. Is the AI infrastructure phase, and honestly this historic semiconductor bull run, finally hitting its absolute ceiling? Because for the last couple of years, the market has been utterly dominated by the companies manufacturing the physical components of AI. But as we know, every massive build-out in history eventually reaches a saturation point. So are we there yet? To answer that, we really have to look at the sheer gravity of capital intensity right now. $600 billion. That is the projected capital expenditure for the year 2026 by hyperscalers. You know, the massive cloud providers like Amazon, Google, and Microsoft. Just let the magnitude of that figure sink in for a second. To put that into perspective, that is roughly the entire GDP of Argentina, being spent solely on building out the foundation of artificial intelligence. So the crucial thing to understand is exactly where all this money is flowing. Right now, it's heavily concentrated in GPUs, data center networking, and high bandwidth memory, which is essentially the ultra-fast short-term memory that feeds these AI brains. But here is the fundamental financial reality we have to face. It is mathematically impossible for big tech to compound this level of infrastructure spending at 50 to 70% year over year indefinitely. The capital intensity is getting really close to its absolute peak. So here is our roadmap for the rest of this explainer. We're covering the gravity of capital intensity, the demanding search for AI return on investment, the rebirth of agentic software, the current valuation asymmetry, and finally, the base probabilities versus the underlying risks. Let's get right into it. Starting with Section 1, the gravity of capital intensity, and how we transition from hyperexpansion to a normalized environment. You see, the logical progression of market maturation always follows a predictable path. Step 1, the initial data center build-out reaches a critical mass. Step 2, as that infrastructure gets built out, semiconductor demand naturally shifts. It moves away from this hypergrowth expansion phase and settles into a much more normalized replacement and upgrade cycle. And then step 3, as a direct result of that, those parabolic earnings beats that Wall Street has just come to expect from hardware manufacturers, they are going to cool down. The mathematical realities of large numbers simply catch up with you eventually. And this brings us to a massive psychological shift that's going to hit Wall Street by 2026. This is our second pillar, the ultimatum. Essentially, show me the ROI. Think about the stark contrast between the past few years and our immediate future. Up to this point, the market has generously rewarded the mere promise of AI, just funneling cash into hardware and massive CapEx. But 2026 really marks an inflection point. It's the demand for proof. Enterprises and cloud providers are going to be under immense pressure from shareholders to actually demonstrate a return on investment on those massive hardware expenditures. If monetization timelines start to slip, the hardware narrative will completely collapse under the weight of that shareholder pressure. Focus is inevitably shifting to the software companies that can actually generate recurring, high-margin revenue from AI applications. Which leads us directly to the real emotional climax of our thesis here, the third pillar, the rebirth of software via Agentic AI. Now, software has definitely had a rough patch recently. It faced a bit of a crisis of confidence because foundational AI models threatened to cannibalize legacy SaaS tools and just radically lower coding barriers. But listen, that is just transitional pain. What we're moving toward is agentic AI. These are autonomous workflows executing complex tasks. We are moving way beyond static software tools and into intelligent systems that can actually take action on their own. As these agentic platforms mature, they are going to prove they can reduce corporate headcount or just exponentially increase productivity. And when they do, they become the new growth darlings, offering those incredibly high gross margins that Wall Street historically loves way, way more than capital-heavy manufacturing. For any of you out there trading tech options, this is exactly where the premium volatility is going to migrate. Let's move over to Section 4 and look at the actual pricing dynamics on the board right now: valuation asymmetry and perfection pricing. There is a very stark valuation asymmetry forming right now. Semiconductor stocks are currently priced for absolute perfection. They rely on a highly concentrated customer base, literally just a handful of mega-cap tech companies, to keep spending aggressively no matter what the macroeconomic conditions look like. Any slight delay in data center construction or a minor cut in CapEx guidance is going to trigger a disproportionate sell-off. Software, on the other hand, well, its multiples have been artificially compressed due to all these fears of AI disruption. This creates a highly, highly attractive valuation asymmetry for capital that is looking to rotate out of that top-heavy hardware space. If you're managing a portfolio or hunting for mispriced options premiums, this divergence is exactly the kind of setup you want to capitalize on. So, what are the actual odds of this playing out? Let's look at our fifth pillar, historical validation, and our probability assessment. You know the old saying, history doesn't always repeat, but it certainly rhymes. In the 1990s, we saw the massive telecom fiber build-out. In the 2010s, it was the 4G mobile tower expansion. And now here in the 2020s, it's the AI infrastructure build. In every single one of these major technological shifts, the exact same pattern plays out. The picks and shovels manufacturers, they always rally first. But the ultimate long-term wealth, that is always generated by the application layer that follows. I mean, think of the software giants born from the dot-com boom or the app economy birthed by 4G. We are standing right on the precipice of the AI software economy. Let's think about how this physical supply chain dynamic is actually going to play out. By late 2026, we absolutely expect to see easing supply chain bottlenecks, plus massive new foundry capacities, the actual mega factories that print the chips finally coming online. And when supply finally catches up to demand, what happens? Pricing power diminishes. The classic boom and bust cyclicality that has always defined the semiconductor industry is going to reassert itself. This is effectively going to neuter the current narrative of infinite growth in hardware. So, taking all of this data into account, here is our objective probability assessment. Based on everything we're seeing, there is a 65 to 75% base case likelihood that the semiconductor narrative turns neutral and Wall Street's capital rotates aggressively back to software within the next 12 to 18 months, which leads us right into late 2026 and 2027. But look, to be completely rigorous and objective, we have to examine the other side of the coin. Let's look at our final section, the commoditization risk factor. There is a real 25 to 35% margin of risk to our thesis here. This is the scenario where semiconductors actually manage to stay in a prolonged bull state. How would that happen? Well, through the commoditization of the application layer. If foundational open-source AI models become so incredibly powerful that building enterprise software becomes cheap and easy for literally anyone to do, then software is never going to regain its premium multiples. The value just gets completely competed away. And in that specific scenario, pricing power remains permanently anchored in the physical hardware and the massive energy constraints required to run these models. And that leaves us with a really provocative final question to chew on. In the age of increasingly powerful open source models, is silicon your only true defensible moat? Honestly, it's the multi-trillion-dollar question that is going to define the next decade of tech investing. I really hope this explainer gave you a clear, structured view of the massive rotation currently underway in the AI space. If you found this breakdown valuable, please don't forget to subscribe to the Noob Selling Options channel for more deep dive analyses just like this one. Thanks so much for learning with me today, and I'll catch you guys in the next explainer.